Since the big leverage flush in crypto in early October, ICP has done a full roller coaster. From around $2.9 in early November, ICP ran all the way up between November 8 and 9 to almost $10, roughly a 3x move. Then, over the following 20 plus days, the price drifted all the way back down to around $3.5 today, a drawdown of more than 60%. In other words, we've just witnessed a complete round trip. On November 4th, the ICP Foundation Dfinity announced that Caffeine was fully open to the public. On that day, trading volume on ICP hit about $1.4 billion, while the market cap was only around $2.8 billion. That implies a nominal turnover close to 50%. The reason I'm pulling out turnover as a standalone metric is that this 50% number is calculated off a reported circulating supply of about 540 million ICP. But that 540 million is, in a sense, an inflated number if you care about tradable float. To see why, we have to look at ICP's staking system. Out of the 540 million circulating today, roughly 240 million tokens are staked and locked inside the NNS governance system. Only around 300 million are actually freely tradable on centralized and decentralized exchanges. For a neuron to earn yield, you need to lock at least 6 months, with a maximum of 8 years. You can choose whether the neuron is dissolving or not dissolving. If you never switch to dissolving, in practice, it's a perpetual lock. Your chosen lock period and whether you are dissolving or not directly determine your APY. If we look at the staking pie chart, the green slice is the not dissolving share of supply. These are holders who are staked and have no plan to unlock. This bucket alone accounts for about 39.37% of total supply. The purple slice is the dissolving stake, people who have decided not to stake forever and are exiting on a schedule. If their dissolve delay is 8 years, they simply wait 8 years before those tokens can hit the market. In total, the dissolving bucket is about 4.92% of supply. Within that, there's one sub-bucket we really care about, dissolving neurons with less than 1 year of remaining lock. In other words, tokens likely to reach the secondary market within the next 12 months. Right now, that's just 1.96% of total supply. ICP, like Ethereum, does not have a hard cap maximum supply. We'll do a dedicated episode on ICP's inflation and emissions later. For today, I'll stay focused on this volatility event. All of this staking background is to make one point clear. On November 4th, the real turnover was closer to 100%. Roughly half the supply is locked in the NNS and can't be traded at all, so the effective float is only about 300 million. Given that, the $1.4 billion volume essentially means that every ICP that could move on exchanges changed hands once on average that day. That's where it gets interesting. In general, when turnover approaches 100%, it usually means the cost basis of the asset has been fully reset. Old holders and old cost levels are flushed out. A new holder base and a new average cost structure is built at a different level. The question we want to ask is, does ICP's current set of fundamentals justify this kind of violent repricing? To answer that, I start with cycles, because cycles are created by burning ICP. They're the fuel that keeps the network running. If you study the cycles burn chart, there's a very visible anomaly on August 29th. Burn volume on that day is almost 10 times a normal day. It doesn't look like simple wash activity to me. My base case is that a project team was doing a large pre-top up to prepare for future usage. Naturally, people familiar with ICP will ask, if cycles are pegged to XDR, essentially to fiat, why pre-fund so much so early? That's exactly the right question. My view is because burning ICP into cycles is one way and irreversible. Once the token is burned, that value is locked inside the network and can only be used to serve future users and compute. From a fundamentals perspective, that's a strong commitment signal. Caffeine fits into this picture as an AI-native dApp factory. It's built to help non-technical users build and deploy dApps. Think of Caffeine as a factory that produces applications. Once an app is generated, it needs to be deployed on the internet computer. Each app spins up one or more dedicated canisters. A canister is essentially ICP's version of a smart contract, stateful, upgradable, and running on chain. So if over time we see canister counts on IC not only grow steadily, but accelerate, that's when we can say Caffeine is really working. At that point, it's not just a chat toy front end. It becomes a true super app factory, driving real adoption and sustained cycles consumption. To be fair, we already had one episode of explosive canister growth in Q4 last year, driven largely by Bob.fun mining. But in hindsight, the market didn't reward that kind of growth at all. The pattern there was simple. You spin up a canister, top it up with cycles, mine your tokens, and once the mining party ends, the network goes quiet. There is no sticky demand behind those canisters. Most of them are effectively zombies. If Caffeine can attract real users and builders to deploy production dApps on IC, then we're talking about sustained demand for the network. That's a different quality of growth. So let's do a simple thought experiment. When might ICP hit its first 1 million canisters milestone? If the market stays in the low activity regime we've seen over the last 8 months, with roughly 5,600 net new canisters per month, then we're looking at around mid-May 2026 to cross 1 million. If activity recovers back to the average level of Q1 2025, around 16,000 net new canisters per month, there's a realistic shot of hitting that mark between late January and early February 2026. Why treat 1 million canisters as a real milestone rather than just a round number on a dashboard? Because for ICP, that's a structural change point along 3 axes: the economic model, the technical architecture, and the market narrative. Economically, ICP is different from most L1s. A canister burns cycles not only when it computes, but also simply to store state. As long as a canister is alive, it continuously burns cycles like paying rent. If the network hosts 1 million such paying tenants, all of them must keep burning cycles just to stay online. That base burn becomes a meaningful floor under the system's economic flywheel. Technically, if ICP can host 1 million canisters without congestion or frequent outages, that's strong real-world proof that chain key crypto and the subnet architecture actually work at scale, not just in white papers and conference talks. At the same time, the Bob.fun period is a useful negative case study. Canister counts exploded, but most of those instances were created purely for mining. The canister state data clearly shows how that fake boom eventually hurt the network. Large-scale creation followed by large-scale death puts stress on state, storage, and node operations. In Q2 2025, we see a red bar, negative growth of about 4.6%. My interpretation is, between Q4 2024 and Q1 2025, mining enthusiasm faded, yields no longer covered costs, and users stopped maintaining those canisters. When a canister's cycles are drained, it doesn't disappear instantly. It first enters a frozen state. Only when there's no balance left to pay for storage does the protocol finally delete it. The result is a kind of ecological washout, a big wave of zombie canisters being cleared from the system. If we then look at Q3 2025, growth flips from minus 4.6% to plus 23% in just 1 quarter. ICP essentially cleared out the bubble and went back to growth almost immediately. That suggests there is real underlying demand on the network once you strip out the mining distortion. What this tells me is, once you remove the noise from pump and dump mining cycles, ICP's ecosystem already had a natural quarterly growth baseline of roughly 20 to 25%. That's a very different narrative from it only grows when there's a Ponzi-like mining game. The open question from here is whether Caffeine can genuinely kick off an era of AI-native, real-world applications built on the internet computer, not just talked about in decks. If that happens, there is a clear pathway for ICP to move from narrative-driven spikes and crashes toward high-quality, fundamentals-driven growth. That's it for today's episode. Going forward, we'll keep tracking these projects and metrics with data, not just stories. I'm TQ, thanks for watching, and see you next time.